Welcome to Personal Finance 101. In today's video, we're going to talk about how can you afford a $500,000 house, preferably in South Florida. We use the South Florida as an example because different states have different type of taxes and different type of regulation applied to the states. So it's easier to have a specific understanding of a specific market, which is South Florida, and that's what we're going to do today. Could you listening to me today, can afford a $500,000 house? A number, because the majority of the houses in South Florida average about $500,000. We're going to talk about the median price of the US market houses, which is roughly $400,000. What our study today will show you, if you want to buy a $500,000 house, depends on the amount of money you want to put down, 3%, 5%, 10%, or 20% down, how much you need to make to buy that house, how much your monthly payment will be, including PMI, which is private mortgage insurance, regular insurance, which is a homeowner's insurance, including taxes. Also, we will include association if you live in a community where you pay association fees. My name is Franz de Villemay. You're listening to Personal Finance 101. If this is your first time listening to us, please consider subscribe and also give us a thumbs up. That will help us to grow better. So today is sponsored by the Toys for the Poor Foundation. You're going to watch a video where ABC covers us when we did our toy drive in December.
Live, the one and only Local 10 News starts right now.
A charitable drive giving back to South Florida children in a big way. More on how donations are really brightening the holidays for these children in need. From taking to giving back, some children in Little Haiti have some new toys and bikes this morning thanks to the donations gathered by Toys for the Poor Foundation. Yesterday was their 9th annual toy giveaway. Kids got to enjoy games, food, bounce houses, and so much more.
We're just doing this for the community and we're giving back to them. So that's why we made this for them, to be able to come and enjoy and have fun.
Congratulations to all the volunteers. The kids got to hang out with Spidey. The toys were donated to the organization by so many of you around South Florida.
You can donate by going to toysforthepoor.org. Toysforthepoor.org. Toys for the Poor is giving toys to the community of South Florida and to Haiti. Support, donate, toysforthepoor.org. Welcome. So as we mentioned earlier, the topic of the day is we're going to talk about if you want to buy a house for $500,000, how much money do you need to make? And when I say you, I mean it can be you by yourself or it can be you with someone else, spouse, partner, brother, sister, friend, whoever wants to put together their income and also their debt in order for them to afford a $500,000 house. The first thing we always recommend when you buy a house is you need to get pre-qualified. So you're going to go to a mortgage broker, a mortgage lender, a bank, whoever you choose to go see, and they will ask you for your information. They're going to look at your income, they're going to look at your debt, and they're going to decide how much money you qualified for. The ratio is 28% of how much you make. So let's say you make $100,000, you can only spend $28,000 of that $100,000 for the year for that particular house. So we're going to do all the calculation and you're going to be able to understand exactly what we are talking about. For example, we are showing you a home price of $500,000. If you choose to put 5% down and you're having a mortgage for 30 years, considering the interest rate is about 6.78%, we're doing that study based on November and December numbers of 2022, depends on where you're listening to this video. In South Florida, property taxes are about 1.2%. Home insurance for this particular house, it's about $2,400 to $3,600, but we put it $2,400. PMI, which is private mortgage insurance. Private mortgage insurance is to be paid if you don't put 20% down in your property. In this case, we put 5% down, so we're going to have a private mortgage insurance of 0.6%. Mortgage payment, principal and interest will be $3,090.32. Property tax will be about $500 a month. Home insurance will be about $200 a month. And your private mortgage insurance will be about $250. Of course, depends on your level of credit, your scoring, and all that. Sometimes the PMI can fluctuate and go a little lower. Total out pocket will be $4,040 a month. $4,040.32 per month for principal, interest, PMI, tax, and insurance. Of course, if you want to add the $200 of association fees, that will add you up to about $4,200. In order for someone to be able to afford that type of payment, you will need to be making about $14,000 a month, which is basically 28% of that amount. So 14,000 times 28% give you about $4,000 a month. And if you want to do it per year, you need to be making about $169,000. So let's say about $170,000. As I said, when I say you, we're talking about yourself buying the house or any party putting together, because you can 2, 3, 4, 5 people can team up together to purchase one house, and they will consider all the people involved in the transaction. They will consider their income, their debt, and also the money that they're going to put together for the deposit. If you're going to buy the house by yourself, you need to make $170,000. If it's 2, 3, 4, 5 of you doing it, combine your salary annually should be $170,000, or your monthly salary should be $14,000. The loan amount will be about $475,000. The down payment of 5% will be $25,000. After you pay the mortgage in 30 years, you're going to pay $1,112,514.91. So basically, you're going to pay $637,000 in interest fees. The loan is for 30 years and will finish in November 2052 or December 2052. The PMI, which is a payoff date, is 126 total payment that will end in May 2033. My name is Franz de Villemay. You're listening to Personal Finance 101. If this is your first time listening to us, please consider subscribe and also give us a thumbs up. That will help us to grow better. Welcome. In October 2019, the median price in the US was $293,019. But that was in 2019. In around January, February 2020, came the pandemic, came the COVID-19 that changed everything drastically. House prices skyrocketed like crazy. The pandemic brought a perfect storm that shook the housing market and created houses to raise 30% of their value. This includes also a mortgage rate that went all the way down, and also an inventory issue in the housing market. Inventory issue means that there are more people looking for houses than there are houses for sale in the marketplace. By the way, in 2022, the median price is $397,549. That was created because of the demand. All the sellers were happy because they could sell their house in one day. The buyers were willing to pay $50,000 more on a property that was listed, and that created a major problem in the market. That's why prices went up. Interest rates, on the other hand, went the other way around. They went down completely. Today, the rate we are right now in December 2022, and the rate is about between 6.7 and 7%, compared to 3% that it was about 12 months ago. So we can say the rate went up about 3.5, 3.6% compared to the way it was last year at the same time. Back at the beginning of the year, you could purchase a $400,000 home with a principal and interest rate payment at about $1,550 per month, because the rate was about 3.125%. Now that the rates are around 7%, a buyer's mortgage will increase by roughly about $800 a month to $900 per month. At least for the short term, the rates are likely to keep climbing before they start going down. So everybody needs to get ready to prepare themselves, because it's not going to be an easy ride. The rates will go down eventually. However, it may get closer to 9 or 10% before it goes down. That happened in the past. So get yourself ready for that particular situation. Instead of the 5%, if you decide to put 20% down in the same scenario of a $500,000 house, your total monthly payment will be $3,302.37. Your monthly payment, which is principal and interest, will be $2,600, property tax $500, and home insurance $200. The loan amount will be $400,000 because you're going to put $100,000 down instead of the $25,000 that you gave before. And your mortgage payment will be $936,000, and your total interest will be $536,000. So basically, by increasing the amount of money that you put down, you will reduce your monthly payment, you will reduce your total mortgage payment, and of course, you will reduce the total interest that you pay. The mortgage will be for 30 years and will end in November 2052. As a comparison, if you're doing the 15-year mortgage with a 20% down, the rate goes down a little bit at 6.12%, and your payment is $4,100. In this scenario, after 15 years, your interest rate total payment is $212,000. I did all the different scenarios, different table, to show you about how much money you need to put down, how much your payment will be, and also you're going to see how much that you save. In the 20% down scenario, where you have an out of pocket of $3,000, $3,300 a month, your salary needs to be about $11,000 per month. And when you multiply that by 12, you need to make about $132,000. So the more down payment you make, the lower your payment is, and the lower your income need to be. Of course, we didn't consider your different debt to income ratio. If you have a lot of debt, which is credit card payment, school loans, car payment, or any debt that reported on your credit report, that will affect your ratio scenario, because the 28% that they use is for the payment of the mortgage only, and they use a 40% to 42% ratio, depends on the bank, depends on the program that you are in. FHA goes up to 45% also to the total debt, which is all your credit card, your school loans, your personal debt, your car payment, medical bills, everything that you have that's reported on your credit report. They add them up together, including the new mortgage you're going to have. The total got to be between, let's say, 40 and 45%, depends on the mortgage program. As the real estate market continues to evolve, so do the salary demands on home buying. Bringing a larger down payment to the table, as I just explained to you, will be helpful in the current environment. But no matter how much money you bring to the sale or you bring to the table, make sure to run your numbers carefully and confirm that the mortgage payment fits comfortably within your income and your budget. Buying a house, it's a choice. I did a video where I compare buying to renting, and it's up to you to decide which one is better. Renting, the landlord is responsible for all the expenses, but when you buy, you're the one that has to keep up with the house. And let me tell you, the keep up with a house that's an old house, most of the time, it costs a lot of money. You've been listening to Personal Finance 101. My name is Franz de Villemay. In today's show, we covered how can you afford a $500,000 house in the South Florida market. How can you, listening to me today, can afford a $500,000 house? How much money do you need to make to purchase that house? And our recommendation is try to put as much down payment as possible. Meaning where you are today, save money. Put money on the side. Try to save 15 to 20% of your income every year. Put that money aside if your goal is to purchase a house. The more money you put down, the better it is for you. The easier it will be for you. The cheaper your monthly payment will be. My name is Franz. Don't hesitate to write comments below. Like, subscribe to our channel. Thank you so much for listening to us.